Hello, everyone, and welcome back. In this lesson, I'm going to be discussing the calendar spread options trading strategy. So what does this strategy do? Buy a long data expiration call option and sell a short data expiration call option, both at the money, simultaneously with the same strike price. And what are the benefits of the strategy? The implementation of a long-term position at a much lower cost. Because if you were going to go out and buy the share, let's say it's a $200 stock, the rules what options are, it's 100 shares for every option, it's going to cost $20,000. This strategy is going to cost a lot less. It also has a lower risk than just buying a call option. If you just purchased a call option, you could lose the entire premium if it moves against you. So there's a large risk of loss. In this strategy, the premium paid is the most that can be lost. This is a position being long volatility. So you're looking for something that has a low volatility, forecasting that the volatility will increase during the duration of the option. Objective, profit from a market and consolidation. So what you're looking for is a market that basically doesn't move much, goes somewhat down, somewhat up, not too extreme, to achieve as much profit from the premiums received from selling short-dated calls, subtracting the time decay loss of the long-dated call option. So as you're selling these short-dated calls, the premium received from selling a number of them versus the loss incurred from the long-dated option will materialize in a profitable situation, as long as the price remains in a certain area. Cons, the price moving too far either way. That's when the trade starts to lose money. The maximum potential profit is predetermined. The profit potential is limited. It can only be to a certain amount, and that's predetermined. Okay, so I'm going to be entering this trade using the Thinkorswim trading platform. This is strictly an example. As mentioned, we're looking for something that's in consolidation, something that we are forecasting will not move in an extreme direction in either way, where most of the profit potential will be achieved if the price action is in consolidation. So for an example, right here, if you consider this area to continue in consolidation, that will be the best case scenario to profit as much as possible. Now, as you can see, the price came down, starting to consolidate. It's been doing this for quite a while, been doing this for almost 3 months. If you're forecasting that this will continue, that this price action will continue right here, a calendar spread may be a good strategy to enter. So let's go to trade. Now, what's important is to make sure that the volatility is low. The volatility right now, if you look at current RV percentile, it's at 38, which indicates the volatility is not high. So that's one thing that we want. Now, the next thing, I'm going to look for a long-dated call option with an expiration of around 3 to 4 months away. So it'll be the closest. Okay, this is over 2 months. This is over 4 months. So I'm going to choose the 4 months expiration. Closest is May 17th, 2024. Okay, so I'm going to select the May 17th, 2024. So looking for something at the money. Price now is at 186.21. There's a 185, but I want to select something that's above the price. So the next closest strike price will be the 190. So right click, buy, go to calendar, going to change this May 24, and I want the sell to be around 30 days away. So it's December 14th. Closest will be anywhere from 30 days to the very next available option would be the January 19, 2024. So I'm going to select that. Now I'm going to change this to 1. So I want to do 1 option. Change both of those to 1. Okay, so we're buying 1 Hershey's option A 17, 2024, 190 strike price call, and the premium is $750. That's what it costs. I'm also selling 1 Hershey's January 19, 2024 at the money, 190 call option. Now there's a debit of $750 because the option purchased has more time on it, so it costs more. The premium is higher, so the debit is $750. Okay, so the next thing I'm going to do is I'm going to right click, analyze trade. Okay, now this is the trade itself. You're just looking at it. Now the maximum profit that this will make is right here. You see the green line? That's at expiration. So the maximum profit shows 190 And that's to the short call. See the expiration, it says 1/20/24. That's the short call, which is right here. It says 1/19, so it means the following day. Okay, so that will be the max profit. The last price is 186.21, so the price can still go down. It can go all the way down here. This is the break even. So it's still profitable, even if the price goes down around 181.58, it still makes money right here. All this area, it can go down that way, and you have somewhat more of a profit zone if the price goes up. See, you could still go up all the way to the break even right here, which is around 201.24. So you have all this area of profit. This whole area is profit. Anything past here is a loss. Anything past here is a loss. But the losses are not substantial. You have a lot of staying power in this trade. Even if it goes below here, your long call can still be maintained. Now, what's important is the short calls have to be exited when it goes out of the profit zone. So before expiration, those short calls have to be closed. You have to roll them over to another short call with another 30 days expiration at the money. And you have to keep doing this until the long call has 30 days left to expire, and then you close the whole trade. So then you would have to close the long dated call that you're holding, and at the same time, close the short dated call that you're holding, and then you close the whole trade. So you keep selling calls as you're holding the long call, because the long call has several months to expire. And the point here is that you have staying power. See, selling these short calls is paying for all the theta loss, all the loss of time that you're getting from buying an option that has zero intrinsic value and 100% extrinsic value. It's going to deteriorate over time because of what's happening to the time. The time itself is going to deteriorate. Now, the option could go up in value, of course, but the time decay is going to increase. So by selling these options, you're bringing in premium, and that benefits from time decay because you're short the options. So cumulatively, as you're selling these options, at the same time, when you're buying the option, the money that you're bringing in from premium will exceed the amount of money that you paid for the long-dated, long-call option. And that's the strategy here. And as a result, you have a wide zone of profit. I mean, look at all this area. This is all profit. This is all profit. This trade does require maintenance. These options need to be exited before expiration. Now, there's two ways to exit. Either they're out of the profit zone, so then you have to roll them to another 30 days at the money. Now, if it's in the profit zone, after anywhere from around 75% profitability is realized, you have to close the short call and then sell another one at the money with another 30 days expiration. And you keep doing this until there is 30 days left on the long call. So by the time the long call expires, you might be able to sell around 5. Since this long call expires in May 17th, and now it's December 14th, this call option has 5 months on it. It has 5 months to expiration. So that means you might be able to sell 4 call options. So you'll be able to take in premium from 4 call options during the duration of this trade before you have to exit the entire trade. So the money being brought in from the 4 call options will exceed the amount of money that you paid for the long call option. And of course, when you close the whole trade, there'll even still be money left on the long call option that you can recoup by the time it expires. So cumulatively, if the price is here, right, if the price is at the maximum amount, that would be the best case scenario. Okay, so go to trade, confirm and send. Okay, so now as you can see, the cost of the trade is quite low. It's only $751.30. Now think about this. If you were to buy, let's say 100 shares, this is going to cost over $18,000 to control the stock. And the point of this trade is you want to have staying power. The staying power is given to you because you're selling all these call options to compensate for the cost of an option that has no intrinsic value. So this really offers a lot of staying power, and that's what's wanted here. You want to be able to stay in this trade to accumulate the premiums that you're selling without having to incur the risks and the costs involved of actually either buying the stock or just buying a call option. In the case of buying the stock, it would cost over $18,000, and you're only putting up $751.30. So go to send. Okay, so let's take a look at the trade. The market's closed now. So as you can see, this is the trade working. So there you go. This was a lesson demonstrating the the calendar spread options trading strategy. So I hope you found this video useful. If you have, please show your support for this channel by subscribing. Feel free to leave comments. Please like this video, and thank you for tuning in.